Next, we'll look at separating the operating from non-operating items from the income statement. Again, same color scheme. If it's red, it's operating. If it's not red, it is non-operating. And this one's easier, frankly. Everything from sales down to operating income is operating. That's why we call it operating income. When we go below, we have to be a little careful. We exclude anything that's non-operating, but we include things that are related to a strategic investment. Again, we'll get into this a little bit later, but when we see something like income from equity method investments, that is an operating item because it's strategic to the company. So accountants and finance people are a little bit different here. Accountants don't count it as operating, and that's why it's put below operating income. Finance people do consider this part of running the business because it's a strategic operation. And notice the funny coloring of what's in yellow there. It has red and it has black. It's called tax expense. Now, the reason it's like that is because there are some taxes that relate to the operating, because the taxes are below operating income, but there's also some that relate to the non-operating items, and that's because tax expense is below those too. So these items that are excluded, interest expense, interest revenue, investment gains and losses, are non-operating. So this tax expense cannot be applied entirely to operating income. Part of it relates to operating income, but part of it got the benefit of a deduction for interest expense, for example. So this is just a preview of something that's confusing, and from many years of teaching this to students, this is the most complicated and tricky part of this entire chapter. So I'll go through it carefully. All right, let's look at the results for Intel. So this is their income statement, and first notice the top has all red, right? That's all operating items. Then it ends up at operating income, so that's a key number, and that's what's highlighted in green there. Then we look at what's below. Interest is non-operating by definition. In this case, it's an expense because it's a positive number. Notice the parentheses. If it's a negative number, then it's an interest income. If it's an expense, it is a positive number. So in the year 2015, it is an expense of 105, and in 2014, it is actually interest income of 43. This just means they earn more in their investments than they pay to their banker. That's because they have so much in investments. The next one that's excluded is gain on equity investments. So this is when they sell an investment. And this is not the same as what we call income from equity investments. So when they sell it for a profit, that's like being an investor. So they count that as non-operating. The yellow is the income tax expense, and it has that same black and red thing going on. Just to remind us that that income tax expense relates to both operating and non-operating items. But the main thing is they have very, very high income, and they don't really mess around with non-operating items. And it's a pretty straightforward and powerful company. Next is NOPAT, net operating profit after tax, NOPAT. And this is the one that drives people crazy. So really pay attention now. So NOPAT equals net operating profit before tax minus tax on operating profit. The first part is pretty easy. Net operating profit before tax is usually simply operating income. And the only thing that would need to be adjusted is if we have income from equity method investments. But in general, it's operating income. The tricky part is what I highlighted in yellow, tax on operating profit. I've mentioned all along that tax expense is for both operating and non. So we start there, but we have to adjust it. And we have to adjust it for how much more tax will we pay if we didn't have a tax deduction for interest expense. So what it says here is tax expense, and then we adjust it by adding the tax shield from the interest expense, let's say, times the income tax rate. And the specific rate we use is called the statutory rate. It's the maximum tax rate that the company pays. And so this is the adjustment. So NOPAT equals net operating profit before tax, NOPBT, minus the tax on operating profit, which is an adjusted income tax number. And so this is the tricky part, and it's probably best to look at an example because these words are probably quite confusing. Okay, let's look at Intel. The top I just lifted from the prior income statement just to have it handy so we could see how it ties together. The bottom is the important part. And so the net operating profit, or NOPAT, NOPAT, is equal to the net operating profit minus the amount of taxes that are related to just operations. In this case, the tax shield isn't a shield. We actually paid more tax because we had a positive non-operating income. And so we would then subtract the effect of that, which is 210, which is the net of these two numbers. So we made $210 million in profit, which means our tax bill went up because of it. By how much? By 37% of it, which is 37% is the statutory income tax rate. And so the net of that is 2714. So 1402 minus 2714 is 11288. That is NOPAT, right? I told you it was complicated. So we better have good use of it, right? So let's look at how we use NOPAT.